Liquidity ratios, what they are and how to use them. Hey guys, today we'll talk about liquidity ratios and how to use them. Let's get right into it. Liquidity ratios are a type of financial metric that assesses a debtor's ability to repay current debt obligations without raising external capital. Liquidity ratios calculate metrics such as the current ratio, quick ratio, and operating cash flow ratio to assess a company's ability to pay debt obligations and margin of safety. The ability to convert assets into cash quickly and cheaply is referred to as liquidity. When used in comparison, liquidity ratios are most useful. This examination could be internal or external. Internal analysis of liquidity ratios, for example, requires the use of multiple accounting periods that are reported using the same accounting methods. Analysts can track changes in the business by comparing previous periods to current operations. In general, a higher liquidity ratio indicates that a company is more liquid and has better debt coverage. External analysis, on the other hand, entails comparing the liquidity ratios of one company to another or an entire industry. When establishing benchmark goals, this information can be used to compare the company's strategic positioning to that of its competitors. When looking across industries, liquidity ratio analysis may not be as effective because different businesses require different financing structures. When comparing businesses of different sizes in different geographical locations, liquidity ratio analysis is less effective. There are various kinds of liquidity ratios. The current ratio is one example. The current ratio assesses a company's ability to pay off its current liabilities that are due within 1 year with its total current assets, which include cash, accounts receivable, and inventories. The higher the ratio, the more liquid the company is. There's also the quick ratio to consider. The quick ratio assesses a company's ability to meet short-term obligations with its most liquid assets, which excludes inventories from current assets. It is also referred to as the acid test ratio. Then there's the question of day sales outstanding. The average number of day sales outstanding is the time it takes a company to collect payment after making a sale. A high DSO indicates that a company is taking an excessive amount of time to collect payments and is tying up capital in receivables. DSOs are typically calculated quarterly or annually. There are, however, some special considerations. Even healthy businesses can experience a liquidity crisis if circumstances make it difficult for them to meet short-term obligations, such as loan repayment and employee pay. The global credit crunch of 2007-09 is the most recent example of such a wide-reaching liquidity disaster. Commercial paper, which is short-term debt issued by large corporations to finance current assets and pay off current liabilities, was central to the financial crisis. A near-total freeze in the $2 trillion commercial paper market in the United States made it extremely difficult for even the most solvent companies to raise short-term funds at the time, hastening the demise of giant corporations such as Lehman Brothers and General Motors. A company-specific liquidity crisis, on the other hand, can be resolved relatively easily with a liquidity injection, unless the financial system is in a credit crunch. This is because the company can pledge some assets if it needs to raise cash to get through the liquidity crisis. A company that is technically insolvent may not be able to take this route because a liquidity crisis would exacerbate its financial situation and force it into bankruptcy. Meanwhile, solvency ratios, as opposed to liquidity ratios, assess a company's ability to meet its total financial obligations and long-term debts. Solvency refers to a company's overall ability to pay debts and continue business operations, whereas liquidity is more concerned with current or short-term financial accounts. To be solvent, a company must have more total assets than total liabilities. To be liquid, a company must have more current assets than current liabilities. Although solvency is not directly related to liquidity, liquidity ratios provide a preliminary estimate of a company's solvency. A company's solvency ratio is calculated by dividing its net income and depreciation by its short-term and long-term liabilities. This metric indicates whether a company's net income is sufficient to cover its total liabilities. In general, a company with a higher solvency ratio is regarded as a better investment. To cap this off, why are liquidity ratios important? Investors will use liquidity ratios to determine whether a company is financially healthy and worthy of their investment. Working capital constraints will also have an impact on the rest of the business. A company must be able to pay its short-term bills with some wiggle room. Low liquidity ratios are a red flag, but the adage, the higher the better, is only true to a point. Investors will eventually wonder why a company's liquidity ratios are so high. Yes, a company with a liquidity ratio of 8.5 will be able to pay its short-term bills with confidence, but investors may consider such a ratio excessive. A high ratio indicates that the company has a large amount of liquid assets. For example, if a company's cash ratio was 8.5, investors and analysts might think it was excessive. The company has too much cash on hand, which is earning nothing more than the interest rate offered by the bank to hold their cash. It could be argued that the cash should be allocated to other initiatives and investments that will yield a higher return. Liquidity ratios strike a balance between a company's ability to safely cover its bills and inefficient capital allocation. Capital should be allocated in the most efficient manner possible in order to increase the firm's value for shareholders. That's all for today, and we'll be sure to catch you all in the next one.